The investment industry has been dogged by accusations of hidden charges for some time, but are the charges really hidden? Or are investors not very good at seeing the impact of charges on their savings? Many investors know that you pay an annual, or what is now called an ongoing charge, of between 1% and around 1.7% a year on actively managed funds. Trackers, or passively run funds, which simply aim to give you the stock market return minus their charges, are a lot cheaper. Their annual charges range from as little as 0.1% to as much as 1% a year, which, by the way, is a hell of a lot to pay for a tracker fund. These charges are disclosed in fund fact sheets and key information documents and are in no way hidden. However, what you don't see so often is the cumulative effect of these annual charges. That's what's shown by this chart, which was drawn up by Ed Moyson of fund research firm Lipper. He looked at the average performance of all open-ended funds based in the UK before and after expenses. This is all UK funds, wherever they're investing. The word expenses rather than charges is significant because what the Lipper data shows is the impact of all costs borne by investors over a 10-year period. Not all of these costs were previously included in the official annual management charge, which is why we had the controversy over hidden charges and why fund managers have adopted the new term ongoing charge, which includes more of those nasty little extras. The figures on the chart show the average fund return in each year between 2002 and 2011, before expenses and after expenses. You can clearly see how expenses reduce the returns to investors. In 2002, 2008 and 2011, when stock markets across the world fell, the effect of expenses was to slightly increase the losses suffered by investors. And in all the other years when stock markets rose, the effect of expenses lowered the returns to investors. So, in the recovery of 2009, instead of a magnificent 32% return, investors got just under 30%. In the crash of 2008, investors lost an average of 27.6% instead of the 26.5% slide in stock markets. The difference between the two sets of figures shows the total expenses paid by investors. Interestingly, the figures change year to year, ranging from a low of 1.1% in 2008 and doubling to 2.2% in the following year. What's going on here? Well, I can assure you, fund managers didn't actually double their charges after the credit crunch. The variation in the total expenses is more to do with the changing mix of which types of funds were doing well and which badly in each year. It's more important to consider the average expenses figure, which over the 10 years is 1.7%, in line with the ongoing charge I mentioned earlier. But the really important figure to look at is the impact of all these annual expenses on investors. The final column shows that the effect of expenses slashed investors' 10-year returns from 98.7% to 71.2%. That's a 28% reduction. Now you can see why investment charges are such a burning issue. Shaving just a few decimal points off funds' ongoing charges would boost investors' total returns significantly over the years in which they're saving for their retirement. To put it crudely, the less that goes to the fund manager, the more that can go to your pension. Now, these figures are based on averages. If you're in a top performing fund returning 10% a year, it's possible you won't mind paying 1.7% a year as much as you would in a mediocre fund returning, say, just 5% a year. Consistent, excellent investment performance is worth paying for. At least that's been the fund manager's defence for years, but the times are changing. Martin Wheatley, the boss of the Financial Conduct Authority, which is one of the new city watchdogs, has said he will look at whether fund charges are fair to investors. Meanwhile, the Investment Management Association, the fund managers' trade body, has bowed to pressure and proposed a new way to show investors the impact of charges on their money. It suggests fund managers express their historic charges in terms of the fund's unit price. For example, if you divided a fund's total costs by the number of units issued by the fund, you might get a figure of 2.5p per unit. If the unit price had risen from £1.25 to £1.35 in the previous year, that would be a gain of 10p or 8%. The fund manager could tell the investor that the 2.5p of costs was the equivalent of a quarter of the growth in their investment. It would be a much better way of looking at charges. Unfortunately, there's no getting away from the fact that fund charges do add up. Investors can only hope that the move to greater transparency by fund managers will in time lead to a reduction in their charges. The figures I've shown you highlight that while it is important to look for the best funds you can, it's just as important to see how much you're paying for your fund.